Have you ever wondered where your money will grow? Best index funds, ETFs, or real estate? In 2025, the investing world is full of choices. If you're not sure which path fits your goals, you're not alone. Today on M.B.A. Perspective, we'll break it all down and help you understand which option might work best for you. Let's start with the basics. What exactly are index funds? An index fund is a type of mutual fund that aims to replicate the performance of a market index, like the S&P 500. It's passively managed, which means fewer trades, less overhead, and significantly lower fees. Most index funds charge around 0.05% annually. That might sound tiny, but over 30 years, it can cost you tens of thousands of dollars due to compound interest.
Now, what about ETFs?
An ETF or exchange-traded fund is similar to an index fund, but trades on an exchange like a stock. You can buy or sell throughout the day, which gives you more control. Many ETFs also track indexes and charge very low fees, often just 0.03% to 0.08%. And because of how ETFs are structured, they're more tax efficient than traditional mutual funds. Then there's real estate. Buying property, whether it's a rental, a vacation home, or a commercial unit, can be a powerful wealth building tool. You may earn income through rent, and the property can appreciate over time. But there are real costs. Property taxes, maintenance, insurance, and potential vacancies. Plus, real estate is far less liquid. You can't sell a house in 5 seconds like a stock.
So, how do returns compare?
Historically, U.S. stocks through the S&P 500 have returned about 10% per year before fees. Index funds and ETFs aim to match that, but actively managed mutual funds often charge between 0.75% and 1.5% annually. That fee can eat into your return every single year. Over 30 years, a 1% fee can reduce your final portfolio by up to 25%, a huge hit to your compound returns. Real estate, on the other hand, has historically returned between 8% and 12% annually when you factor in appreciation and rental income. However, returns vary widely by location, leverage, and market timing. Plus, most real estate investing requires a lot more hands-on management. Let's look at an example. If you invest $10,000 today, earning 10% annually with a 0.05% fee, you'd have about $174,000 after 30 years. But if that fee were 1%, you'd only have around $132,000. That's a $42,000 difference, all lost to fees. With real estate, your $10,000 might be used as a down payment on a leveraged property. That leverage can amplify returns, but also risks, and you'll still need to pay closing costs, insurance, and ongoing repairs. Now let's talk about taxes. ETFs are usually the most tax efficient. Index funds come next. Real estate offers write-offs like mortgage interest and depreciation, and even 1031 exchanges to defer capital gains. But tax rules around real estate are more complicated. Liquidity also matters. ETFs and index funds can be sold at any time. Real estate is slow. It can take weeks or months to close a sale, especially in a declining market.
So, which one is best?
If you want simplicity, minimal fees, and long-term growth, index funds and ETFs are hard to beat. If you're looking for cash flow and are comfortable with more work, real estate could offer solid returns and tangible assets.
But why not consider a mix?
Many investors build diversified portfolios with all three, balancing growth, income, and stability. The best investment isn't just about performance. It's about your goals, your time frame, and your risk comfort level. And remember, compound interest can build your future, or it can erode it if you're not careful with fees. If you found this helpful, hit that like button and subscribe to M.B.A. Perspective for more straight-to-the-point financial breakdowns.
Your smarter future starts now.